presentation on making effective financial presentations. My name's Paul Lauer, and I'll be facilitating this webinar, which should take somewhere around 1 hour. The structure of the seminar is there's 7 topics, and we'll run through those topics. There's a slide presentation to illustrate many of the points. At the end of each of these sessions, there'll be an opportunity for questions, and I'll open up the question module. You'll see at the bottom right-hand side of your screen, there's a section where you can enter a question. Depending on how many questions we get, I'll pick 1 or 2 at the end of each session to keep things moving along, and I'll answer those. Any questions left at the end, then I'll deal with those at the end of the seminar. Let's have a look at what the webinar is about. The webinar is essentially about communicating information. And in that subtitle, you have both the purpose and the challenge of financial presentations. What is the information that we need to communicate? What should it be about? What should it focus on? And how should it be communicated, taking into account the audience to whom you're intending to communicate it? And those are the 2 aspects that we'll address in this short webinar. What's the information that should be addressed? What's the best way of communicating it? Very short word about me. My name's Paul Lauer, as I said. My background is in finance. I trained in finance. I trained as an accountant with a number of international companies. In the 20 years of my career before I moved into training, I held 3 separate chief financial officer positions, finance director positions with global companies. And the striking thing I noticed when I moved to doing that kind of work from doing more regular accounting and management accounting work was that instead of communicating with financial professionals similar to me, I was largely communicating with people that didn't have a financial background. And that made me really think about the way that I was presenting information when I started to move into those roles, because people that aren't financial people have a different perspective on business. They don't look at things the same way, and information has to be presented and communicated in a way that makes sense to them. And it's based on that experience, a pretty hard experience in those years, that I've based this seminar and training courses, longer training courses like this. So the key questions for us when we're thinking about making financial presentations: what kind of information is it that we're communicating? Why is it important? The information that we're communicating must be relevant to decision makers. As I said, as we move up the organization, we find we're increasingly dealing with non-financial managers. And the kind of information that we're providing very much needs to be in the form of insights into organizational performance that allows the people to whom we're communicating this information, the non-financial, typically non-financial executives, the information must be carefully chosen and communicated in a way that helps these people make better decisions. And their decision making is focusing around achieving the organizational strategic objectives. And that's what needs to be at the back of our mind when we're designing these financial presentations. I'm going to illustrate this point with one of the most important financial measures called return on investment in, I think it's the third section of the webinar that we're going to be doing. And that's an illustration of how we take what's a fairly widely known concept, but make sure that the concept is understood and the correct aspects of it are focused on and communicated effectively. And so that brings us on to the other key question. What are the most effective means of communication? What are the challenges that we face in providing this information, as I said, specifically and typically to non-financial people? What are the challenges in communicating? And what can we do about it? What are the most effective ways of dealing with these challenges? So these are things I'm going to try and deal with in this fairly brief webinar we have today. So this is the structure that I'll be following for the webinar. We're going to talk very briefly about the strategic context for financial presentations. We're going to talk about the value and limitations of financial measures. We're going to focus specifically on one of the most important financial measures, which is the measure of profitability in organizations. It's a key measure of financial performance. Then we'll move on to the communication aspects of financial presentations, and we'll consider why is it that non-financial managers struggle with finance? What are the problems that we commonly face in making financial presentations to non-financial managers? I'm going to talk then fairly briefly about data visualization and using graphical methods to improve communication with non-financial managers. And then we'll finish off by looking at how we design effective financial presentations. And I'm going to be focusing on one particular aspect of this, which is designing tactical financial dashboards. So that's the structure. When I show this presentation view, you'll see there's an AV pod appears in the right-hand side. If you want to move that to the right, you can click on the little icon that you can see that looks a little bit like a screen, and you can move it off to the right if you want to. So let's talk briefly about the strategic context for making financial presentations. The aim of any organization is to create value for its key stakeholders. That's true with profit-making organizations. It's true with charity organizations, governmental organizations, and so on. The illustration on the slide is how typically we look at this stakeholder hierarchy for a profit-making organization. We can consider stakeholders as being internal stakeholders in the form of management and employees, connected stakeholders in the form of shareholders, debt providers, banks in other words, customers, some people say customer is king, suppliers, external stakeholders in the form of the public and the community and the government. And the challenge for any organization is to balance the needs of these different stakeholder groups. And how you balance these different needs will depend on the type of organization, on the philosophy of the organization. Indeed, the whole concept of balancing the needs of different stakeholders is constantly evolving. You'll see different approaches to this throughout the world in different parts of the world. But in business, what we're typically trying to do is achieve this virtuous circle where the key to success is to balance the needs of the customers and the shareholders, the owners of the company. And the key to an effective strategy, the key to an effective business model is to find some way of satisfying customers. If you can do that, then you will increase profitability. By increasing profitability, you can satisfy shareholders. Satisfied shareholders are more likely to invest in the business, which will give you additional capital when you need it to meet the changing needs of customers and to deal with changes in business models. And so by doing this, we can achieve this virtuous circle. If we balance carefully the needs of the other stakeholders, then that further helps to maintain the capability of the company and maintain confidence in the company. These concepts are at the foundation of competitive business strategy, and they're reflected in the concept of the business model. This is Johnson, Kagan's, Christensen's approach to business models. That they suggest that there are 4 components to an effective business model: a customer value proposition that defines exactly how you create this unique offering for your customers. A profit formula describes how you create value for shareholders. It has a revenue model that determines the relationship between the price you're charging and the volume you can sell. It describes your cost structure and the way they behave. It defines a margin model based on how much you can make on selling each item that you're selling and how much you need to sell to cover the fixed costs of the organization. And it defines a net asset turnover model. And we'll come back and consider these components of the profit formula in a little more detail when we look at measuring the return on investment. The resources, the key resources in a business model, are those things that you need: the people, the technology, the information, and so on. And the way that they coalesce together to determine the processes, the way that you habitually carry out and get things done. These resources will determine the cost structure of the organization, the number of people you need, the kinds of investment you have to make in technology. All of these things determine the cost structure. So these elements of the business model, as suggested by the arrows, are closely interlinked. And the challenge for us in making financial presentations, where we're typically focusing on the profit formula, to provide insights to managers to improve their decision making, one of the things we need to consider when we're communicating these financial concepts is how they relate. So these are the key elements of the business model. So aspects of customer relationships and customer satisfaction will have a direct bearing on how much we can sell. The key resources and the way that they coalesce around processes will determine the cost structure. The efficiencies we achieve in those processes will determine the cost structure and the margin model. So these things are interrelated, and it's critically important to understand how they're interrelated in this concept of the business model. So that's the foundation, that's the background to the challenges that we face in communicating this information. So let me turn on the question mode. If you have any questions at this point, enter them at the bottom of the screen. I'll give you a minute or so to do that. Okay, there's no questions coming through immediately, so let's move on. And I'll take some questions at the end. Okay, let's look at the issue of financial measures. Peter Drucker famously said, "It is only that which can be measured that can be managed." And so we need to be very careful in choosing what information it is that we use as financial measures, because that's what we'll be focused on and that's what will be managed. One of the key measures of one of the key financial measures that we focus on is profitability. So the question is, how do we measure profitability? And this is a good illustration of the question, what is it that we should measure, and what is it that we should communicate to managers? So have a look at this slide for a couple of minutes. This shows two companies, Alpha and beta. In the top part of the slide, you can see it's an extract from the income statement for the year to the end of December 2018. It shows the sales revenue, operating profit before interest, charges and taxation, and the profit after tax. In the bottom half of the slide, you can see a statement of financial position at the end of 2018, and we can see a comparison there between the two companies, Alpha and Beta, showing the assets and liabilities and net assets. So something for you to think about when you're looking at this slide for a few minutes: which is the more profitable of those two companies? How do we measure profitability? Whilst you're looking at this slide, there's a couple of questions come up. I'll see what the questions are. What we can clearly see from this slide is that Beta makes an operating profit before interest, charges and taxation of $65 million. Alpha makes an operating profit of just under $59 million. So in very simple terms, we would say that Beta is more profitable. Clearly, a profit of 65 million is greater than a profit of just under 59 million. Is that the most relevant measure? What about if we look at the relationship between the operating profit and the sales revenue? How much of each dollar of revenue do the two companies convert into profit? In the case of Alpha, a profit of just under 59 million on sales revenues of 912 million gives them a profit margin of 6.5%. Beta makes an operating profit of 65 million on sales revenue of 150 million. So they're making a profit margin of 43.3%. So if we look at profit margin, we would say Beta is significantly more profitable than Alpha. But is that the key question? Is that the right way of answering the question, which of these companies is more profitable? If you found yourself in the fortunate situation of having $20,000 in spare cash that you didn't need to use right now, then you might consider making an investment. The kind of investment you would make would depend to a great extent on your appetite for risk. And you would select your investment on the basis of what you would get back on your $20,000 were you to invest it. So if you invested your $20,000 into a savings account with a bank right now, in most countries you'd get a fairly low rate of return because bank deposits are fairly low risk. And so you might get back $200 on your $20,000. If you lent your money to a new business, you'd get perhaps considerably more. You might get $4,000 back. And in relation to your original 20,000, that would be a much greater percentage. So if we apply the same principle to Alpha and Beta, the investment in Alpha, we can look at that, we can consider that either from the point of view of the shareholders' equity of $274.6 million, which is invested in the net assets of 274. And in that particular case, Alpha makes a return on investment 58.9 million on 274 million, gives them a return on investment of 21.5%. And if we did the same thing for Beta, the 65 million on shareholders' equity and net assets of 974 million gives them a return on investment of 6.7%. So if we look at the key measure of return on investment, we would say alpha was more profitable. And this is an illustration of the point of being very careful about which measure it is we use to communicate that focuses management attention on areas for action, for improvement against the company's strategic objectives. Now, for profit-making companies that are owned by shareholders, the high-level strategic objectives of the organization are expressed in terms of creating value for the owners of the company, usually with some other secondary objectives related to the high-level strategic objectives. So how do we measure shareholder value creation? One of the questions that was given by Dr. Alabi at the end of the first session was how does these concepts relate to non-profit organizations? Well, their strategic objectives are different rather than expressed in terms of creating value for shareholders. They're usually expressed in creating value for other key stakeholders. So if we take the example of a non-profit making organization as a hospital or a medical charity, the high level objectives are expressed in terms of outcomes for the key stakeholders in the form of patients, for example. There'll be other measures typically around efficiency and effectiveness. The focus in this short seminar is on profit-making organizations. So as we said in those cases, we're focusing on the creation of shareholder value. One of the common concepts for measuring shareholder value is a concept called total shareholder return, TSR. And TSR is a combination of dividends that we pay to shareholders, which are distributions of profit in the form of cash. So if we pay $1 to a shareholder as a dividend, we're creating value for them. If the shareholder paid $10 for their share and the price of the share increases to $12, then we've also achieved share price growth, and that will also create value for shareholders. How does that help us in defining the key financial measures that we use? Well, the share price of a company should reflect the value of the business. And over the long term, although from day to day we see, as we know, if you look at stock markets, you'll see significant variations from day to day. But over the long term, the share price of a company should reflect the value of the business. An economist will tell you that the value of a business is a function of its ability to generate earnings from its assets, taking into account the risk in those assets. And one of the ways that we can measure earnings is using profits. And what research has shown us over a considerable period of something like 30 years is that there's a very high correlation, there's a very strong link between changes in the value of a business and changes in a measure called return on investment. And that makes return on investment a key financial measure for us. So financial measures in most profit-making organizations are the key focus of the board, and there's a great deal of financial information shared. But there are limitations to financial measures, and this is something else that we need to keep in mind when we're making financial presentations. Financial measures have been used for well over 200 years since the Industrial Revolution. They tell us some very important things about organizational performance. They're very important, but they don't tell us everything. And that's becoming increasingly the case with modern companies, particularly tech companies. Apple is a great example of this. If we look at the net asset value of Apple at the 28th of September last year, if you look at the statement of financial position for Apple at that date, you'll see its net assets are $242 billion. The market value, based on its share price at the end of September, I can't remember exactly what the share price was at the end of September, but the value was well in excess of $800 billion. So there's a great deal of value in companies, in these tech companies like Apple and Uber and Google, that's not represented and is not measured financially. And this value is typically vested in what we call internally generated intangible assets. The value in these companies, the value in many companies, is generated and represented by the value of customer relationships. In companies like Apple and Google, particularly, a lot of the value in the company is represented by human talent and the skills and expertise. It's based on intellectual property, like software. It's based on specialized processing capabilities, and it's increasingly based on brands for companies like Apple and Google and Microsoft, for example. And as you will know, if you have a financial background, you'll know that these areas are problematical. IAS 38 on intangible assets and says that internally generated intangible assets typically can't be recognized and shown in the balance sheet. So many of these things can't be measured financially, but that doesn't mean that they can't be measured. And so one of the important things that we have to do when we're making financial presentations is acknowledge the importance of these intangible assets and find measures that tell us about our performance in these important areas and link those to financial measures. And at the very late part of the webinar, I'll show you an example of how we can do that with one of the dashboards, with a tactical dashboard. So return on investment is the financial measure I'm going to show you as an illustration of how to focus on how we measure things financially and how we present them and how we highlight specific aspects of these things to non-financial measures. The thing we need to talk about very, very briefly when we're considering return on investment is the relationship between the return on investment and the risk. And you'll recall a few minutes ago I said that from an economist's perspective, the value of a business is a function of its ability to generate earnings from its assets and the risk in those assets. And when we look at some illustrations of return on investment in a minute or so, we'll be looking at different returns on investments from different companies. And whenever we make these comparisons, we have to make it in the context of the risk in these different kinds of companies. The relationship between risk and return is such that the way that all investors behave is represented by the green line on the chart. On the horizontal axis, we're measuring the risk that the investors perceive they're taking. On the vertical axis, we're measuring the return that the investors will seek. And the way that we all behave is as we perceive greater risk being taken, we will seek a greater return, represented by the green line that rises to the right. If we trace the origin of that line back to the vertical axis, at that point, perceived risk is zero. And as you can see, at this point at the origin, investors still seek a return. And that's because of what we call the price of time. So if we give up the use of our money, even if there is no risk involved, then we will typically seek a return. If we expect to be exposed to inflation during that period, we'll expect a compensation for that. So the red line represents the price of time and inflation, and the difference here represents the risk premium. So we're going to move on and look at an illustration of how we measure return on investment. Any questions before we move on to that section? I'll give you a minute or two if you have questions to type them in, and I'll deal with one or two. Okay, no, I can't see any questions so far. If you're writing your question, don't worry, I'll come back to it. I'll come back to it in a minute or at the end of the next section. Okay, so Pramila Edward asks this question: how do you explain this to non-financial persons? That's a very good question. In fact, that's the essence of the webinar, because what we're already getting into are some technical aspects of finance. So that's a very good question. One way in which we do this, I'm going to expand on this later, is by using visualization techniques. There's an expression we have in the UK. You may have heard it before. It's called a picture paints 1,000 words. And research, human psychology research, shows that the human brain responds something like 500 times faster to an image than it does to numbers and words. So one of the things that will help us in explaining these things is to use graphics and data visualizations that we're going to talk about later in the seminar. So the simple chart I showed you then about the relationship between risk and return is an example of that. It gives you something. It gives something that managers can look at, and you can explain using the graphic. The other thing you have to do is to understand how these measures are driven, what it is that affects them. And the other very important thing to do in explaining these things to non-financial people is to tie them back to the other important aspects of organizational performance, like customer satisfaction and operating efficiency. And we'll look at some examples of that later. Okay, there's another question that I'll come back to. There's a couple of questions I'll come back at the end of the webinar, so we can move on. Okay, so let's look in a bit more detail at this measure called return on net assets. We're going to focus on this because it's a return on net assets is one of a number of measures that we use to calculate return on investment. It's very similar. In fact, depending on how you calculate it, when I calculate it is the same number as a measure called return on capital employed. There are other measures you may have heard of, you may use in your own organization. But I'm going to use this measure as an illustration of how we measure return on investment, what it is that drives it, and how easy it is to mislead and misdirect people by focusing on the irrelevant aspect or the inappropriate aspect of any particular measure. And this is a good way of illustrating it. The picture in the slide is a German company called BASF. It's a petrochemical company. I think it's the oldest petrochemical company in the world. And we're going to look at their numbers for 2013. In 2013, this company's sales revenue was 74 billion euros. It had an operating profit, that's profit before interest, charges and taxation, of 7.2 billion euros. And the investment in its net assets, its non-current assets, its current assets, less its current liabilities, the investment in its net assets equal to its capital employed was just over 53 billion euros, 53.1 billion. So if I take the operating profit of 7.2 billion in relation to the 53.1 billion, if we divide 7.2 by 53.1 and multiply it by 100, it tells us the return on net assets for the company in 2013 was 13.5%. Now, this measure is driven by two further measures. If you like, these are the levers that affect return on net assets. One measure is called profit margin. The other measure is called net asset turnover. Now, let's flip back to this business model concept. We said shareholder value, the value that we create for the owners of the business, is determined by the profit formula, a revenue model, a cost structure, and a margin model. The profit margin is a function of the revenue model, the cost structure, and how that determines the margin model. All of these things will drive profit margin. Net asset turnover model is the fourth component that determines the return on investment that shareholders get from an investment in a company. And net asset turnover is the second of these key measures that drives return on net assets. So let's have a look at profit margin. Walmart, largest company in the world if you measure by sales revenue. Walmart's sales revenues in 2013 were just over $469 billion. Their operating profit before interest and tax was $27.8 billion. So if we express the profit as a percentage of the sales revenue, it gives us a profit margin of 5.9%. Let's look at another industry. This is a real company. It's a company called Fly Leasing. Fly Leasing owns 115 of these Airbus A321s. It leases them. It's not an airline. It's a leasing company. It leases the airline. It leases these aircraft to airlines that operate them. What do you think the profit margin for this kind of operation would be? It was 5.9% for Walmart, just under 10% for the chemical company. What do you think it would be for an aircraft leasing company? Well, in 2013, their profit margin was just over 48%. They made an operating profit of 178 million on leasing revenues of 369 million. So just over 48%. So quite a considerable difference. The supermarket company has a profit margin of 5.9%, the chemical company 9.7%, and the aircraft leasing company has a massive profit margin of 48.2%. So how do we explain these differences? Well, the most obvious difference between an aircraft leasing company and a supermarket business like Walmart is the cost structure. An aircraft leasing business is fairly straightforward to operate. You need some people that will negotiate the leases with the airlines. You need some lawyers to draw up the agreements. If you're going to offer a maintenance facility, you'll need a few engineers in one of the major airports. Walmart, on the other hand, is one of the largest employers in the world, and their cost structure is obviously significantly different to the airline, to the aircraft leasing company, and that largely explains that difference in profitability. There are a number of other factors that will affect profitability. On a longer course, we could explore some of these things. You will be able to see from the slide copies that you get at the end. You can refer back to these, and if you're not familiar with these concepts, you can do some research of your own. Other significant factors that affect profit margins are the stage that you're at in your product life cycle, particularly with technology products. Companies that are able to differentiate themselves and persuade their customers that they have superior value in their product. Apple's very good at doing this, will make superior profits. Companies like the Inditech, the company that owns Zara, that can innovate very quickly. They're typically very profitable. Companies like Toyota that achieve very high levels of operating efficiency are more profitable than most other car companies. Companies that can build very, very precise customer value propositions. Low-cost airlines have been very good at doing this in the past. And more generally, the structure of the industry and the nature of competition and the way that the dynamic forces between the buyers and suppliers operate in the industry, all of those factors will determine the profit margins of different companies and different industries. And all of these factors will largely explain why we see these big differences in profit margin, as we saw in the illustration. So the question is, when there are such big differences in profit margin, how do companies like Walmart attract investors? Well, the answer to that question is, when we look at profit margin, we're only looking at one of these two important measures. And when you look at media reports, particularly in the non-specialized media, when you look in newspapers, you'll often see sensational headlines based on these kinds of profit margins. So you typically see a headline, aircraft leasing company makes ridiculous profits of just over 48%. It's outrageous. And that's based on focusing on one of these two key measures. What does the net asset turnover measure tell us? Let's look at the illustrations from before. If we look at the German chemical company BASF, sales revenues of 74 billion, net asset investment of just over 53 billion. So to generate sales revenues of 74 billion, BASF had to invest just over 53 billion. So the relationship between those two numbers, the 53.1 represents 72% of the 74 billion. Textbooks refer to that as capital intensity. How do we explain these things to non-financial people? Well, a good way of illustrating that point to a non-financial person in a presentation would be to say, in the petrochemical industry, to generate €1 of sales revenue, the company had to invest 72 cents, 72% of revenue. What does that look like for the aircraft leasing company? To generate $369 million of leasing revenue, Fly Leasing had to invest just under $3.3 billion. The relationship between those two numbers, the capital intensity, is 893%. Present that to non-financial managers. You say in the leasing business, to generate $1 of leasing revenue, this company had to invest $8.93. In the chemical business, you invest 72 cents. Enormous difference. Just as there was in the profit margin, there's an enormous difference in this relationship between capital investment and sales revenue. Now, net asset turnover also tells us about operating efficiency. It tells us about how effectively the company can manage its investment in its net assets. A good illustration of this is what the textbooks call capital utilization. If you look at the way that different kinds of airlines operate, if you, for example, look at a low-cost airline like Fly Dubai, if you were to, when the airlines start up again, if you were to go and observe one of these flights, you'd find, if you went to Dubai airport, that it would typically take somewhere between 15 and 20 minutes to prepare and turn around one of these Fly Dubai flights to go on its next sector. Low-cost airlines work on a very precise business model where profitability depends on high levels of utilization, high levels of what they refer to as loading, which means filling every seat on the aircraft. Emirates is a traditional airline where they do things differently. And if you observe one of these flights, you'd see that it typically takes around an hour and 40 minutes to get one ready to go off on another flight. So there's an important difference between the capital utilization in these two different business models. The low-cost airlines achieve much higher levels of capital utilization. And this is also reflected in this measure of net asset turnover. So let's look at Walmart for 2013. Their sales revenues were 469 billion, just over. The investment in net assets was just under 137 billion. Net asset turnover is calculated by dividing the sales revenue by the net assets. So if we divide the 469 billion by the 137 billion, 136.9 billion, it gives us a net asset turnover figure of 3.43. The petrochemical company achieves a net asset turnover of 1.39. The leasing company achieves a net asset turnover figure of 0.11. Now, what's the relationship between these three key measures? Well, this is very important. If we multiply profit margin by net asset turnover, it gives us return on net assets. So if we do that for Walmart, profit margin of 5.9%, net asset turnover of 3.43%, 3.43 multiplied by 5.9, return on net assets for Walmart in 2013 was 20.3%. For the chemical company, a 9.7% profit margin, a net asset turnover of 1.39 gives us 13.5% net asset return on net assets. For the leasing company, 48.2%, very high profit margin, 0.11 net asset turnover, very low net asset turnover. 48.2 multiplied by 0.11 gives us 5.4% return on net assets. The key measure of return on investment, return on net assets, is highly correlated to the creation of shareholder value. And if we look at the numbers in the return on net asset column, in the case of Walmart and the leasing company, they're the reverse of the picture in the first column, profit margin. And this illustrates my point, is our own starting point is to understand exactly what these financial measures mean, exactly how these financial measures relate to what's happening in the business itself, and how we explain these changes in return on net assets has to be related when we're explaining these things to key decision makers, to non-financial managers. We need to be able to relate these changes and what drives these measures and changes back to what's happening in the organization itself. Now, based on this understanding, we can develop a number of other measures that will help us to drill down further into what's driving this key measure of return on investment, this key measure of return on net assets. So we know that it's driven by profit margin. We can drill down further into profit margin and look at the gross margin that we're making in our business. If we look at the variable costs in our business and deduct the variable costs from the sales revenues, that will give us gross margin. We can look at that gross margin as a percentage of sales revenue. We can look at the fixed costs, the overhead costs in relation to sales, and those are also key measures of financial performance that drive profit margin. We can drill down further into net asset turnover and look at non-current asset turnover, fixed assets as we used to call them. We can look at working capital turnover, and indeed we can drill down further into working capital turnover. This is particularly important in manufacturing companies and trading companies. We can drill down further and we can look at how efficiently we're managing inventory, how efficiently we're managing the receivables by measuring days sales outstanding, and how efficiently we're managing the payables. And based on this understanding, based on this insight into what these financial measures tell us, then we can further help non-financial managers. We can translate these measures into business strategy. We can use these measures to direct us in areas where we can improve shareholder value. So what we can see from our understanding of return on investment, return on net assets, that we have broadly two strategies that we can pursue to improve shareholder value. We can pursue a revenue growth strategy, and we can pursue a productivity strategy. If we're going to grow revenue, we can look at ways of building the franchise, look for new revenue streams, new territories, new customers perhaps, new products, new channels. We can look at ways of selling more, increasing value to existing customers, look at ways of fine-tuning the pricing that we use with customers by looking at how they perceive value. Productivity strategies are focused around improving the cost structure, finding effective ways of reducing variable costs and fixed costs without affecting quality or efficiency, and looking at ways of improving asset use efficiency, so becoming more efficient, reducing investment in inventories and receivables. And so we can see when we have this understanding of what's driving this key financial measure, it allows us to put this in a strategic context and build this into our financial presentations. Any questions? I've covered quite a lot in that section, so you probably have more questions when you've had time to reflect on it. Any immediate questions that you'd like to ask now on that section on return on net assets? So one of the questions, this question came in from the earlier session: are the gains taxable? If by the gains you mean profits, then that will depend on the part of the world you're living in. In most parts of the world, certainly in in Europe and North America and Australia, if you make a profit in your business, then yes, the gains will be taxable. In some parts of the Middle East, Saudi Arabia, for example, the profits themselves aren't taxable. Instead, there is, for example, in the case of Saudi Arabia, there is an Islamic charitable contribution that's calculated based not specific on profits, but a combination of profits and company assets. Fred Okafor asked this question: the greater the risk, the greater the return. Doesn't higher risk apply for higher failure? Indeed, if you're looking at the returns that investors will seek in new businesses, in new industries, then there is indeed a much higher, typically a much higher rate of failure, and investors will seek a greater return for that. So yes, that's exactly the case. Net asset turnover equals sales revenue divided by what? Great, good question. I went through that section of the webinar. It's a fairly short section. Net asset turnover is sales revenue divided by net asset value. So let me go back to the slide. Let me go back to one of the slides, and I'll illustrate that for you. Let's go back to the Walmart slide. So in 2013, Walmart's sales revenue was $469 billion. Its net assets were $136.9 billion. If you divide the sales revenue, 469 billion, by net assets, 136.9, you get the net asset turnover figure of 3.43. That's where net asset turnover comes from. Okay, so let's move on. We've talked about financial measures and choosing the right financial measures, and very importantly, understanding exactly what they mean, what drives them, and how they relate to the company's business model and company's strategy, and how they can help decision makers to make better decisions. The webinar is about communicating information. So we've talked about the information that we're going to communicate. Let's talk about the difficulties, the challenges of communication. So two things for us to think about. Why do non-financial managers struggle with finance? What causes them their problems? The other thing to think about is, what are the common problems that we create when we're making financial presentations? What are the common mistakes that people make, financial people make, when they're trying to present information to non-financial managers? Think about that for a minute. Think firstly about, if you're a non-financial person yourself, think about what it is that you struggle with finance. If you're a finance person, try and put yourself in the position of a non-financial person and think about what it is that makes it difficult for them. My experience over more than 25 years working in finance was that there are a number of very common reasons that non-financial managers struggle with finance. You've probably noticed that, probably noticed a long time ago, that people are different, but you tend to find different kinds of people. And all of the people I've found and worked with in finance, to some extent, are quite similar. They've always, even from being quite young, I was always interested in numbers, and I quite enjoyed maths when I was at school. But I noticed that quite a large number of the other children didn't enjoy maths. They enjoyed other things to a greater extent, and people talk very broadly about people being creative people and being analytical people, and I think that's broadly true. And one of the problems we have as finance people is that once we embark on a career in finance, we spend the early part of that career typically working to a large extent with people like ourselves. In the later part of a career, as you move up through the organization, you probably start to spend more time with non-financial people and creative people and marketing people and those kinds of things. But what you find with these people that aren't like us finance people is that they're generally reluctant to engage with numbers. If I see a set of numbers, I look at it and I start looking for patterns, and I start trying to figure out what the numbers mean, and I'll try and make sense of them. If I see an article in a newspaper, or somebody gives me a financial report, or I look at an annual report for a company, I'll do that. A lot of people won't. They don't engage with numbers. It's not helped by the fact that, and this might vary from country to country, but certainly my experience in the UK is that we don't give financial training to managers. When they leave university and become marketing managers or sales managers or engineering or production managers, as they move through the organization, we don't generally give them financial training. And with these kinds of people, they're unwilling to engage with large volumes of data, and they can't draw meaning from financial reports, and they're put off by jargon and acronyms and a lack of a simple and clear message. And the common problems that we face when we're making financial presentations are common mistakes I've seen when I've seen financial presentations made by other people is that you have to avoid, as far as possible, using financial jargon. When we become financial professionals, we automatically slip into using financial jargons like EBITDA and PBT and all of these things. And you can't use those kinds of jargon with non-financial people because they don't know what they mean. But they'll usually be too embarrassed to tell you that they don't know what they mean. And so you immediately close down communication. Common problem is to present too many numbers when you're making financial presentations. It's very tempting if you've spent a couple of weeks building a fantastic Excel worksheet for a financial presentation. It's very tempting to hand over Excel worksheets to non-financial people. And this is also a turn-off for them. Other common mistakes: presenting full financial statements. Common mistake is to present lots of data without giving any interpretation and converting it into information. Common mistake is to fail to help managers to draw any meaning from the numbers or any insight from the numbers. So you can't just hand over plain numbers to non-financial people. What you need to do is to tell a story and have a clear message in mind. Now, I'm conscious that we've just run over, it's just gone over 10 o'clock. These webinars are nominally 1 hour seminars. We've probably got about 10-15 minutes left to finish off on the seminar. And I think that will pretty much see us finished. So bear with me, we're going to move on now and talk about data visualization and making effective financial presentations. What we'll do at this stage, if you have any questions about common mistakes and the difficulties that non-financial people have, type those in whilst I'm speaking. And any questions you type in now, I'll come to at the end of the webinar. But what is data visualization? It tells you what it is on that slide. It's a graphic representation of a specific set of data. A good visualization will present objective and quantifiable information. Typically, it will focus on a small, selective data set. This is particularly important when you're dealing with non-financial managers, is not to try and present too much information in one report. That's a common mistake. Make complex numbers easy to understand. If the sales revenue is $35,217,000, then make that 35 million. Keep the numbers simple. Data visualizations are usually fairly simple and very focused. I'm going to show you an example right now of a brilliant data visualization. This was published by Crest in the UK. I think Crest is part of Unilever. It's a toothpaste brand. And they published this in some magazines a while back to illustrate the point that the average person only spent 50 seconds brushing their teeth this morning. They spent 50 times longer on Facebook. The data visualization tells the story in half a second. The average time that people spend brushing their teeth, the recommended time to brush your teeth, and how long you may spend on Facebook. They say a picture's worth 1,000 words, and that is a brilliant data visualization for however many words there are in that sentence. It's brilliantly illustrated in the data visualization. And as close as you can get to that in your financial presentations, you'll be doing very well. So some tips for designing charts and graphics for data visualization for financial presentations. The challenge for us is this: simplicity can be boring, but interesting can be confusing. Let's look at some common graphical techniques that we can use effectively in financial presentations. If you're good with Excel, you'll know how to produce these. The Excel help function online is very, very good. It helps you produce these. If you have Office 365, you might have access to Excel's Power BI tools, which will help you to produce these kinds of columns. The challenge for us with Excel, it will allow you to do lots and lots of different and interesting things with graphics. The challenge for us is it will also allow you to do lots of bad things with graphics. Column charts are possibly the most common method of graphical data visualization. They're great. They're clear. They're easy to read. It's very easy to see patterns and find specific patterns. This data set here from 2010 is the most popular boys' names that were given to babies. That's the top 10. You can look at that later. But what you can see very clearly from that, very, very quickly by looking at the chart, is that the most popular name in 2010 in the UK was Oliver. And that stands out very clearly. Problem is, it's not terribly exciting. It's quite difficult to do anything visually interesting with column charts without changing the color or the shapes or anything like that. If you attempt to do that, what very quickly happens is it's superficially more interesting, but it's a very poor choice of shapes. It's very hard to make comparisons with those shapes. If you look at the far right-hand side, this is supposed to be 3%. This is supposed to be 6 times greater. You can't really see that from that. So it's superficially more interesting, but not terribly helpful. This is less interesting, but it's very easy to see what's happening. Pie charts, very common in newspapers, very common in financial presentations. Very nice, very good when there's one dominant value. Quite helpful when there's only 2 or 3 values. Quite good when everything adds up to 100%. Very quickly gets very confusing though. This is just horrible. This is something that was published by, I think Oracle published this, business objects products currently used. You just can't draw anything from that without looking at the numbers. So you may as well just have published the numbers. The only way of making this worse would have been to use Excel to turn it into a 3D pie chart, and then that would have been truly horrible. Bubble charts are becoming quite popular. You'll see these quite a lot now, and I think they're quite nice. They're quite elegant. You can use colors and you can lay them out and be quite creative with them. I've compressed this bubble chart from a newspaper. If you have some more time after the webinar, you can enlarge it and see what it's actually talking about. It's measuring confidence in the UK government in different measurements. You can look at this later and see how the thing works. The basic principle with using these is that the relative size of the data is related to the area of the circles that you're using. And I think these are quite elegant. Stacked bar charts are quite nice. Good alternative to pie charts. And if you choose the colors sensibly, they can be very elegant. Can get difficult to compare the values in the middle, as you can see from that illustration, and smaller values might get lost. So with the rule with many of these things is in some particular circumstances, they will be very good. In others, they will quickly become less useful. So the art with the visualization is to choose the right thing for the right job at the time. So if you have any questions about those, start typing those and we'll come back to those. I'm going to finish off by focusing on a particular kind of visualization that we can use. in finance, and that's something called a dashboard. What we're aiming to do with effective financial presentations is to merge form and function to create an outstanding visualization. There's 4 components to making an effective and outstanding visualization: the data, the story, the chart, and the design. So when you're selecting the data for a presentation, and in the 21st century, the thing that we're not short of is data. There are enormous amounts of data available in most organizations these days. If your company operates SAP or Oracle, if it's collecting big data from social media, there will be an enormous amount of data. Much of it will be in your ERP system, your enterprise resource planning system, in the form of a relational database. So you'll have an enormous amount of data. That's not the problem. The challenge is thinking about choosing the appropriate data for the message, the story that you're trying to tell. So think about this. Is your data a comprehensive and credible data set? What you need to do when you're planning a presentation is look for interesting patterns and trends in data. And one way of doing this is to extract the data into Excel, which is typically what finance people do, and then use things like pivot tables and SUMIF functions, and use the graphic functions, column charts, bar charts, all of those things, line charts. Using charts is a very quick way of identifying patterns and trends in data. If you know how to use them, you can also use the statistical tools in Excel to measure regression and correlation and those kinds of things. And that will allow you to produce integrity in the data. You then need to think about the story. What's the story you want to tell to your audience? The important thing you'll need to think about first when you're designing presentations, of course, is who exactly is the audience. Is it production managers? Is it the senior board? And that will determine the story you're going to tell. Good thing to ask yourself when you're starting to think about the story is, what is it your audience cares about? So if you're presenting the results, the quarter results to the sales management team, to the sales team, then what they care about, what they really care about is their bonus, their sales bonus. So they want to know what the sales were achieved, where they were achieved, and if they missed the target, why it was they missed the target. And so you need to think about the story that relates to that audience. Find a story in the data that will resonate with your audience, and this will bring, in the context of your audience, this will bring meaning to the presentation. Now you need to think about what the visualizations are that you're going to use. Which charts will bring your story to life? Simple is boring, exciting can be less informative and confusing. So we need to strike that balance. Which charts are you going to use? Choose the best chart that will tell your story, and this will bring function to your presentation. And then lastly, you need to think about the design. What does your chart look like? Will it look better if you change the colors? Are there other ways you can improve it? You can experiment. Excel's pretty good for this. You can experiment with color and shape until the information is beautiful. And this will give you form. And the best designers always say form follows function. And so those are the golden rules for making effective finance presentations. One of the most effective ways of making effective financial presentations is using dashboards. We use dashboards for different things. There are strategic dashboards. If you have balanced scorecard in your organization, that's an example of a strategic dashboard. If you're in a manufacturing environment, if you go to the production line, if you're using something like SAP, you'll find that the online processing monitors produce dashboards that tell them about real-time performance in production. Those, we refer to those as operational dashboards. In finance, typically what we're concerned with are what we call tactical dashboards that are used to manage and optimize specific business processes. So, for example, in sales, marketing, and human resources. And dashboards are a good way of presenting numbers with data visualizations. So, similarly to what I've just told you about building a presentation, when we're designing a dashboard, the first thing we start with is the message. What's the purpose of the dashboard? What is it? What's the message that we're trying to get across? Secondly, who is the audience? What's the level of their knowledge, their financial knowledge? What is it that they're interested in? What is it that's important to them? Then you need to decide what are the correct measures that you're going to use. You're primarily focusing on financial measures. What you also have to decide, bearing in mind what we said in the early part of the webinar about internally generated intangible assets, which can't be measured financially, but can be measured. For example, it's very difficult to measure financially the value of a customer relationship, but you can measure your performance in a customer relationship. You can measure it very simply by looking at what's important to customers. So we can measure customer satisfaction. If you're in a business that sells and delivers things to customers, what's very important to customers is that they get it in full, on time. So you can measure OTIF, on time, in full deliveries. They're not financial measures, but they're very important measures that will determine your sales efficiency and sales performance. And then fourthly, you need to decide where you're going to collect the data that will give you these relevant measures. And then you can start building your dashboard. You can build dashboards in Excel. That's a very good place to build them. If it's a dashboard that's going to be produced regularly and is unlikely to change, it may be investing some money and having it developed as a SAP report. Otherwise, Excel will do it quite nicely. If you're able to use pivot tables and data manipulation functions like SUMIF, you'll be able to load the source data, very large volumes of source data. It needs to be clean data, doesn't have to be formatted. What you can then do using pivot tables and Excel functions is analyze and manipulate the data to produce the measures that you want to present. And typically in an Excel workbook, these three circles would be represented by three separate sheets. Keep everything separate, and it makes it nice and easy to manage. And then the third sheet you'll need is the presentation, which is your formatted user dashboard, combining numbers, tables, graphics, and text. And I'm going to finish off, conclude the webinar by showing you an example of one of these dashboards. This is a tactical sales and margin dashboard. You can see it's a combination of numbers and data visualizations. I produced this in Excel. The Excel workbook had three worksheets. It had a worksheet where I extracted a very significant amount of data, multidimensional data from a relational database. It had a second worksheet where I used SUMIF functions to summarize that large amount of data into sales by region for each of the months of the quarter, sales by region compared to budget, margin by region, as you can see. I used the Excel data functions to extract the sales and margin for quarter one for each of the salesmen that you can see in this section. And I used the analysis to break it down by month. There's a data visualization. It's using very simple column charts. I've gone for simplicity rather than excitement. I've made it a little bit more interesting by changing the colors for the different kinds of presentations. And for people that want to look at the numbers, I presented the data in these tables at the bottom, so you can also look at the numbers. I've presented the key summary data in this little box here. So sales and gross margin, actual compared to budget. I've put the numbers into millions so that non-financial people are not looking at very large amounts of data. And I've shown a percentage. Now, all of these measures are financial measures, but what I've done here is related these numbers to two very important non-financial key performance indicators, KPIs. This company sells things directly to its customers. Two of its key performance indicators in terms of its customer relationships are customer satisfaction and how quickly orders are delivered to customers and the extent to which they're delivered in full. And in this Speedo, this was generated in Excel from the data from the database. This is a measure of customer satisfaction. This is an OTIF measure. One of the company's high-level strategic objectives is expressed in terms of achieving a target customer satisfaction of 98%. It's like 95%. And similarly, the target is to achieve a minimum OTIF of 95%. And in both cases, in the first quarter of 2018, they fell below the target level. So the sales managers can see that certainly part of the reason for the underperformance in quarter one was because of the underperformance against these two key performance indicators. Somebody just asked me a question, what is OTIF? OTIF is on time in full. So if you've ever ordered something, if you've ever ordered furniture, for example, to build for a bedroom, or if you've ever ordered furniture for a kitchen, the most frustrating thing is that you get everything you need apart from 2 or 3 important doors or cabinets. And one of the most important things to customers is that when they make an order for something, they get the full order delivered on time. So OTIF is on time in full. And if you're running a competitive business like this one, your OTIF needs to be in excess of 95% to keep customers happy. So that concludes the webinar. There is a question left over from an earlier session. I'll read that question now. If you're pressed for time, that's the end of the formal webinar. So if you're pressed for time, you can leave us now. If you have a little bit more time, I'll answer any questions from the previous session or any of the other sessions. If you have any questions, write those now, and I'll answer them as they come up. So a question here, is it advisable for managers to have some basic financial training? I would say yes. I'm biased because I have a financial background, but I would say to anybody, if you're asking me as a non-financial person, I would say from my experience, if you have ambitions to move up through an organization, then sooner or later you will need to have a basic financial understanding. Because my experience over the years was that, now this may be a particular problem in the UK, but I quite commonly came across people that were promoted to board level. In other words, they were part of the very senior management team, as I was as the chief financial officer. And I could see that these people were initially delighted to have realized their ambitions and been promoted to a very senior level. And then they very quickly became very anxious because they didn't understand the financial information that was being circulated, and they didn't understand the questions that other senior managers were asking of them. And when in the organizations I worked in, when I heard that people were being appointed to senior positions, I would usually have a quiet word with them and ask them if they would like a bit of help. But the best time to get financial training is at a somewhat earlier stage in your career. And then if you have an understanding of business finance, it will help you to make a greater contribution to what's happening in the business, and may even accelerate your career development. So that's my view on that. Kindly explain the overhead percentage on sales. Okay, one of the things that's always useful to use when we're comparing one year with another, rather than looking at absolute numbers that change from year to year, relative measures are always much more useful. So overhead percentage on sales, like gross margin on sales, is a good thing to compare. And overhead percentage on sales is calculated by taking the total overhead cost for the period and expressing it as a percentage of the sales for the same period. And when you have that percentage, you can compare this year with previous year and the year before. You can compare this month with previous month, same month last year. And even though the actual numbers themselves change, the percentage is always directly comparable. And that's the advantage of doing this. It's a technique that we call common sizing. And it's a very useful thing to do with any number that you regularly compare from one period to another. If you can find something relevant on which to calculate a percentage, that will be very, very useful. What presentation style is best for financial presentation? Excel or PowerPoint? Some of this, good question. Some of this is personal preference. What I always did, because I found it gave me the greatest control in a presentation, was I would prepare the visualizations, the data visualization. The dashboard is a good example. That was built in Excel. If I was presenting that at a board meeting or a sales managers meeting or a strategy meeting, what I would usually do, and as I said, to some extent it's a personal choice, I would paste that dashboard into PowerPoint, and I would include it as part of a presentation. Now, I've always found PowerPoint very useful. I use it in training courses. It gets a bit of a bad press. If you use LinkedIn, if you look at some of the conversations about training, you'll see lots of people talk about death by PowerPoint, and people overuse PowerPoint, and they do this and they do that. All of those things are often true, but PowerPoint is a tool. It's like any other tool. It's not PowerPoint's fault that people overuse it. The current version of PowerPoint with Office 2019 or Office 365 is a fabulous set of tools, and it's up to you to use it to design an effective presentation. And to answer your question, I would always use PowerPoint, because if you copy an Excel dashboard and paste it into PowerPoint as a high definition graphic, and you can look up how to do that, then it's not going to change when you nobody can change it. It's frozen, and it will be there when you show it in your presentation, and you can incorporate it with other graphics and text and tables or whatever else you want to use. So kindly confirm if you have a training to teach beginners how to process raw data. effectively to present it professionally, processing day books to financial information. We're in the process at ASDEC of developing a number of online courses for the remainder of this year. During the current pandemic crisis, none of us are sure when the travel restrictions will be lifted. So as we speak, there are some courses being developed. So I would recommend that you look at the ASDEC website and see if anything like this is being offered. If you communicate with the ASDEC team on the website and make it a suggestion, if there's interest in that, that may be something that we can develop for delivery at some point during the rest of the year. And thank you for that question. Okay, well, I can't see any more questions in the queue. It's been a short presentation, a short webinar. It's been quite intensive, and I've rattled through it fairly quickly. The webinar will be published on the ASDEC website, so if you want to look at it again and review any particular sections of it, you can go back and have a look at it. But I hope you found something useful in today's webinar, and good luck with your financial presentations. Thank you very much. See you again soon.